So this guy on Instagram, you'll see, for those who are watching, he sent this screenshot here of a video, and he sent, I'll play the video. He said, "Hey, M3 team, getting fed a lot of content like this by Instagram. It seems they are selling the great Australian dream as safe as houses, but omitting the part about leveraging to the hilt. Would love to know your thoughts." So this is a guy, the reel is from, what's his?
Not Jack Henderson.
No. Scott Curry.
Oh, yeah, Scott Curry, yep.
I said we're headed into a boom
Anyway,
2024 through
Hang on, let's play this.
2027. Now, people laughed at me. I was mocked online. And if you wind the clock even further back, 2020, nobody wanted to invest in Perth or Brisbane. Zero interest. They said those markets were dead. I directed my clients to invest there. I invested there personally. Look at them now. Now let's talk about demand, because this is where the market is about to surprise a lot of people. We're seeing more and more investors re-entering the market, but this isn't greed. It's logic. It's strategy. And it's everyday Australians who are doing it. See, according to the ATO, the majority of Australian property investors own just one property. They're not billionaires, they're teachers, nurses, tradies, doctors, hardworking professionals who simply want a more secure future for their families. They're looking around and realizing something extremely powerful. Property prices in Australia have never declined to...
He's just another property dude.
Never declined for what? 2 consecutive years, is that what he said?
Have never declined for 2 consecutive years. Long-term, property delivers higher returns than the stock market. And when you step back and look at where Australia's wealth actually sits, the majority of it is in housing. Some of the richest people in the country built their fortunes through property. The wealthiest companies in Australia are banks, and the majority of their portfolios are in property. So when people...
all of those facts are true, but not particularly relevant to the argument.
This guy's just pretty much...
He's a property spruiker.
Yeah. He's like, no one was buying in Perth in 2000. I bought my client's property in Perth. Perth went to the moon. Ta-da.
And Perth was a perennial underperformer for a long time. I mean, it's a market that's much more volatile than the rest of the market.
But I think the underlying question is, yes, this guy is saying, I'm getting fed all this crap, safe as houses, but they're omitting the part about leveraging to the hilt. And that
is true.
And that's right. Like you mentioned Jack Henderson.
Mm-hmm. He of the red MAGA hats.
I don't know him.
He must live around the corner from you.
I think he was. I think I saw him at Tallulah once, maybe. But anyway, he's got this big thing online and he's got all these properties and all that stuff and looks after a lot of people. I think and I don't know, I'm just allegedly-ing, it would be using corporate entities to get around the lending serviceability stuff.
Yeah, and he's not alone in spruiking that strategy.
No, that's right.
Which is why Macquarie had to...
Yeah, well, and CBA are turning it off as well for new clients. So absolutely. You will, if you want to go hard on property and get to the 20 properties or $20 million, like why, number one, but number two, there's going to be significant leverage. And even, I still don't understand when someone goes out and go, I've got, $30 million worth of property portfolio. And even, is it Scott O'Neill, him and his wife have like, because he was on the show a couple of years ago, the commercial property guy, like $150 million in property. I always want to know when people throw out these big figures, what's the actual equity position? And this is just my personality. I would rather have 10 mil owned outright with zero risk than 30 million in value.
And I must, you've got a question. So if that guy, I don't know who the guy you're talking about is, but if his day job is selling property or helping people buy property, so his income is fundamentally driven by the property market, investing all of your net worth in real estate just shows he doesn't understand risk or diversification. And that's a big red flag in my book.
It is, but you've also got to remember the most quote-unquote successful investor in the world, Warren Buffett, personally doesn't have much diversification. But you live by the sword and you'll die by the sword. And I mean, that's fine that you've got property only, but if you get flushed, well, don't whinge that you got flushed when you've got...
Ask Dave Ramsey.
Yeah.
What happens when your note gets called?
Yeah. And Dave, friend of the show.
He's been on the show.
He's been on the show, Dave Ramsey. We will remember as well, everyone, Dave Ramsey didn't get rich Mark II from not having debt. He got rich Mark II by telling people not to have debt. So,
But, I mean, the facts are that the vast bulk of Australian household balance sheets is made up by real estate, 2/3 of which is owner-occupied, and the rest is investment or thereabouts. And it's backed by a metric shit ton of debt. Not as over the whole portfolio. I think the average LVR, like debt divided by total value of real estate, is only about 30% across the country. So I looked at it as a single portfolio. That looks pretty stable, looks pretty safe. But that does hide lots of people who have no debt and some people who have lots and lots and lots of debt.
but it speaks to like, so these type of property people that are really heavy on leverage up, get rich from property, all that stuff.
Because there's a metric ton of commissions that goes with it.
Yeah, but also they've got big social media followings because everyone wants to be financially successful and they want to know how to do it.
Yep.
So I follow those people where I would all day long rather engage someone like John Pigeon than potentially one of these businesses because there's no BS about get rich quick and all that. Like John's quite successful property investor in his own right, but he doesn't have 150 to 200,000 Instagram followers, but he's not out there every day saying, let me show you how to get to 40 properties in 5 years. He doesn't have his clients going, all right, go here. Yeah, we'll introduce you. We'll set you up a trust or a company here. We'll hold the properties there. We'll get lending. Yeah, good to go. It's just none of that Wild West stuff. And the problem is we haven't had a huge downturn on this island.
Do you know the last?
Well, I was going to say, it's not even the GFC, realistically, because the debt wasn't in Australia with the GFC. Sure, equity market
but Sydney
fell.
property values did fall. But the last time we had a nationwide double-digit fall, 1969.
Yeah.
But we did have some pretty serious falls in Sydney and Melbourne in the early 90s.
Now,
We had some big falls in Perth in the post-GFC period.
but I think what I'm saying is we haven't had a systemic issue where interest rates have gone up, people are being flush with property, can't sell, like literally catastrophe, like we potentially saw in the GFC in the US. And I know that their system was different where just go, oh, I'm bankrupt and all that. But it's been relatively good sailing for the best part of 40 years on this island.
Well, certainly 30. The early 90s were pretty tough.
Well, 30 might be considered the best part of 40.
Well, it is. It's 75% of 40.
Yeah.
But if you look,
But I think
yeah,
what I'm
Westpac
saying
was
is-
almost brought to its knees in 91. It almost bankrupt, right?
And during the GFC, I heard, I think it's public and I've said it on the show before, the reason that the Rudd government put the $250K bank guarantee in,
The Clayton's guarantee.
because he got a call, basically the Rudd government got a call from Suncorp saying we've got 4 days of cash left. So there was about to be a run, well there was a run on cash. So all that to say, various property spruikers, and I would call that video guy a property spruiker. He's selling property. I don't know I'm not making any allegations of anything dickery going on because I just saw that reel that old mate sent to us. But you've just got to understand if you want to get lots of properties and have heaps of debt, you will carry inherent risk and you may get a knock on the door from the risk keeper.
But, looked at realistically.
That was a parallel to the Grim Reaper.
Oh, very good. Yeah. The most people over their lifetime will benefit from some real estate investment. So most broad diversified portfolios should include some residential real estate. It's the biggest asset class in the country.
You don't own any in Australia, do you?
No, not right now, no.
Would you ever again buy a place to
Yeah, I
live in?
will once I work out where I want it to be.
Actually, we were talking before because Vince hasn't owned a property in Australia in 10 years. He can qualify for the shared equity scheme.
That's bizarre.
Although you might get done with income caps.
Well,
they remove them. I forget.
No, I think on the shared equity there is an income cap, but I'm sure that could be fixed.
They remove the cap on the 5%.
Yeah.
Yes.
But getting back to this question, most people should have some real estate. We probably have too much home, a lot of people, but there's no doubt that residential real estate done well, and it does come down to buying the right asset in the right place, is a great way to build wealth. It is a shocking way to provide for retirement income, but it is a great way to build wealth. And so it should be there. The question is how much and when, and are you sure you're buying the right assets? I can point you to a property that's worth less than it was 15 years ago, and I have a file of these things, not just one of them.
You can get them. A lot of them are apartments.
Well, this is...
Wasn't there a city, a pocket in Melbourne where it literally was a dog?
Docklands is Melbourne, but I can point you to a townhouse in Melbourne that's worth less than it was 15 years ago.
Yeah.
And big chunks of Tasmania worth less than they were 10 years ago. It's not hard to find property going backwards. But done well, the average Sydney property has done 5.8% growth a year for 40 years. And couple that with 3% rent, that's not a bad return.
I'm kind of, because I think I could qualify in terms of my disposable income and all that stuff to go to town with these property spruikers. Buy one in the trust or a company and get around and just really gear up, right? I could do it. Anyone could do it effectively. Well, you know what I mean?
The big limitation today is serviceability.
No, but you can get around that.
But only if the properties are cash flow positive.
Yeah, and they're harder to find.
Which is pretty hard. To buy quality property, residential property, that's cash flow positive at more than 60% gearing is really, really hard.
Yeah.
Right? And that means you need 40% equity. So where's that coming from? So there's a whole bunch of constraints that unless you're prepared to lie to the bank, that strategy is really inapplicable for most people. I
think having said that, I can get more money, cap out my serviceability, my own name, buy in other entities. I could do it. It's quite easy once you get to a level of income, right? But it's not a goal of mine to say on Instagram, hey everyone, it's Glen here. I've got $40 million worth of property and I'm crushing it. Because I've never really mentioned my net worth publicly anyway. I've got a good life, Vince. I wake up whenever I want. I do whatever I want. I've got a good life's good. Why do I need to add an extra layer of stress from gearing up, going to town to get that $30 million portfolio, or I own 40 properties and I mean, the handful of properties I've got now shat me to tears. So I'm considered in that 1% of property owners. But I think it speaks to why do you want to, is it an ego thing? And that's why I've never got into this slinging piss competition, whatever they say, of doing hey guys, this is my net worth.
Yeah, it's
who cares?
It's not a particularly meaningful metric.
It's an ego thing. I would rather have less money and more enjoyment and flexibility in my life that I got now than being able to do a reel to say I've got 10 million or 15 million or $150 million in property and all the friggin' extra stress and garbage that it carries. And people go, oh no, you get good property managers and all that. Oh yeah, I know. But guess what? You're still a decision maker. Like you still will carry more inherent crap in your life.
Yeah. I mean, I've made good money out of property over the years.
Yeah, so have I.
But I just find it very difficult to get excited about it. And the biggest thing that frustrates me as an advisor, and I'm qualified in real estate, so we don't have a horse in this race. I'm not that specific guy, but you see a lot of people in the property space who will lead with, how many properties do you need to retire? That's just looking at the answer the wrong way. The question is, how much capital at what yield do you need to generate the income you need?
The worst thing that people say, and you see it come up, I've got 3 kids, I want to buy 3 investment properties to leave a property for each kid. I love the intent, just build wealth in your own name. Because then what? One of the kids is obviously going to get more money if you're leaving individual properties, because unless you're buying 3 houses that are identical in the 3 suburb on this, like, this is fallacy, guys. Just build wealth.
But yes, property is important. You should have some at the right time, in the right place, the right asset structured.
And if you don't, your super fund has been looked after because you've probably got CBA is like 8% now of the ASX or something. You've got a fair chunk of the banks in your super fund, and that's why the Australian banking system is so well. One of the reasons. You look at the comparisons, I think they're the 4th strongest in the world or something.
Highest margins.
Yeah, floating rate, literally printing money with these floating rate mortgages. It's wild. All right.
Funded off largely floating rate debt.
Yes.
So they've got no mismatch.
No. Like it's so yeah, to those things, yes, they do not mention the inherent risk. And that dude that I showed the reel of, I forget what his name was.
Scott Kuru.
Or Jack Henderson, who we mentioned. I don't know anything about them. They were just 2 names that popped up, and it could be amazing or not. But that shtick isn't a shtick that I adhere to because I don't care for it.
But yeah, most of our members would have some form of real estate investment.
Hey, it's Glen here. Thank you so much for watching today's video. You made it to the end. Can I ask a favor? Can you hit that like button and maybe hit subscribe if you want to get notified when we release further videos just like this one, whether you watch the Money podcast or Retire Right. And remember, if you want to learn more about investing, I've got an investing book, The Quick Start Guide to Investing, and there's a link in the description to get your hands on a copy. Thank you so much. Bye.